Middle market companies are the most dynamic part of the U.S. economy, increasing revenues and adding jobs faster than either big business or small. The middle market did it again in the third quarter of 2016 and delivered an especially impressive performance in job creation. We track those numbers at the National Center for the Middle Market. I'm Tom Stewart, the Executive Director of the National Center for the Middle Market at The Ohio State University Fisher College of Business. And here with the latest data from the Middle Market Indicator. The Middle Market Indicator, the MMI, is a quarterly pulse check of the performance of companies with revenues between $10 million a year and $1 billion a year. That's the middle third of the U.S. private sector. About a third of jobs and GDP are created by companies that are smaller. About a third of jobs and GDP belong to companies that are bigger. And in the middle, in that $10 million to $1 billion range, is the middle market. The third quarter data for the third quarter MMI were collected in the first 2 weeks of September 2016. Let's look at middle market revenue growth. In the third quarter of 2016, performance was excellent. The middle market as a whole delivered top-line growth at an annualized rate of 6.3%. Now, we've been tracking that number on the middle market indicator for 19 quarters, and over those 19 quarters, the average top-line growth is 6.4%. So 6.3 is basically spot on with the average that we've seen in the middle market indicator. Now, that number is down from what we saw in the second quarter when it was 7.2%. That was one of the highest numbers we've seen. The revenue growth number does tend to oscillate. These figures are not seasonally adjusted. And interestingly, the 6.3% growth we saw in the third quarter exactly matches the 6.3% that we saw in the first quarter. So this lower growth rate does not constitute a trend, and it doesn't constitute a warning. And we should remember that 6.3% revenue growth is very strong, however you count it. By way of comparison, the annualized growth rate for the multinational giants in the S&P 500 during this period was just 2.5%, less than half as much as the middle market. Almost all the slowdown in the growth rate in the middle market can be attributed to the performance of the largest companies in the segment, those with revenues between $100 million and $1 billion. Now, interestingly, this group, over the 19 quarters that we've been tracking the middle market indicator, this larger group has had the strongest growth rate, 7% on average, compared to 6.4% for the middle market as a whole. Why the drop? It's hard to say, but one explanation is that these companies are the ones that are most likely to be exposed to international economic conditions, and particularly to the effects of currency changes. In this period, the US dollar has grown stronger against the currencies of all our major trading partners. The Canadian dollar, the Mexican peso, the euro, the British pound, the yen, and the Chinese RMB. So that may be one of the causes of this. There are industry effects, too, and industry explanations for some of the growth rate. We saw particularly strong growth in construction and retail. Those are 2 quarters in a row in which those two industries have led middle market growth. Indeed, construction's performance was awesome, 10.5% annualized top-line growth in the construction industry, and that growth was experienced basically across the board in the industry. 76% of construction companies reported significant revenue gains. Of course, this figure includes the summer months, always the best in the construction industry, but it is an annualized figure. Economists, indeed, have noted that non-residential construction has been the major or one of the major contributors to overall GDP growth, and it's clear that the middle market in this, as in other things, continues to lead the way in top-line growth. The third quarter of 2016 saw a surge in hiring by middle market companies. Payrolls in the middle market are 4.9% greater than they were at this time a year ago. Now that compares to payroll increases of 2.3% for big business and 1.8% for small business. So that means that middle market companies added about 15% more jobs than big and small business combined. We've seen this consistently. Mid-sized companies are the engine of job growth in the U.S. economy. That 4.9% figure is also the highest we've seen since the fourth quarter of 2014, and it marks 4 quarters in a row, a full year, in which the rate of job creation has accelerated. Talking about the jobs number 3 months ago, I said we'd need to see a couple of more quarters before we could declare that there was a trend, and caution should remain the order of the day. But it's good news. So is the quality of the jobs that are being created. 3/4 of the new jobs are full-time, and just 2% are reported to be temporary or seasonal jobs. Where are those jobs? Number 1 is in construction. With powerful top-line growth, it's also adding staff at a strong clip. Healthcare and services industries are likewise big hirers. All 3 of these are industries that are relatively resistant to automation, which means that you don't see dramatic increases in labor productivity, and when revenue growth goes up, payrolls tend to rise more or less in parallel, though of course there are economies of scale. Middle market company payrolls increased about 5% in the last 12 months. So what are all these new staffers doing? 63% of companies say that they've added jobs in operations. 51% have added jobs in marketing and sales, and 36% in IT. Much higher numbers than we see in finance, HR, or other things. So these people are actually producing revenue rather than counting the money or managing the bureaucracy. That's a good sign. Presumably many of these new IT jobs are in cybersecurity, a defensive role, but we also know from the hiring we see at The Ohio State University and from other patterns that there's lots of hiring in big data, analytics, and other marketing functions or market-facing functions in IT. Data we analyzed a couple of years ago showed that more than 1/3 of middle market companies expected to expand their work in big data and analytics, and the job numbers seem to say that they are actually putting that into effect. In addition, some not insignificant number of new employees are inventing the future. Talent investments are a necessary part of market expansion and innovation, which are 2 of the biggest levers of growth for mid-sized companies. In fact, we learned this quarter, talent is the number 1 lever that executives pull when they seek to accelerate innovation. Asked how they make innovation happen, 54% of executives say that they hire new talent, 39% say that they increase R&D, and 19% say that they make acquisitions. With solid gains in revenue and performance in the 3rd quarter of 2016 and a big jump in hiring, it's not surprising that middle market companies are feeling pretty good about the future. There are some cautionary notes in the tune that the numbers are playing for us. 8% of middle market executives looking forward expect sales to decline in the next 12 months. That's up from 5% in the previous quarter. 41%, of course, say that sales will increase, and that's down a tick. There's a similar tightening in the spread between executives who expect demand to fall compared to executives who expect demand to increase. And there's also a narrowing in the gap between executives who expect the business climate to worsen and those who expect the business climate to improve. So if you put those 3 forward-looking numbers, sales prognostication, demand prognostication, and business climate prognostication together, you see a reduction in an index of short-term forward-looking expectations for middle market companies. In addition, executives express some concern about the impact of any interest rate increase that the Fed may impose. About 1/4 of executives say that a rise in interest rates would cause them to defer or reduce capital spending, and a similar number say they might delay hiring, and a similar number say that they might hold on to more cash if that happens. Of course, interest rates are already at historically low levels, and any increase in interest rates would still leave them remarkably low. So that caution about interest rates should be taken, I think, with a grain of salt. That said, given these cautionary signs, there are also some bullish indicators. Election year political uncertainty will be cleared up soon. International economic uncertainty is a stronger concern, but rather surprisingly, this quarter we saw an increase in middle market executives' confidence in the global economy, which rebounded from 49% to 56%. And confidence in the U.S. economy stayed steady at about 70%, as did confidence in local economies at about 80%. Perhaps more important, middle market executives tell us that they feel pretty strongly in control of their own business. National Center for the Middle Market data demonstrate time and time again that these executives are aggressive and cautious about managing costs. They don't sit on huge reserves of cash, they don't have enormous untapped lines of credit, and they don't like to take on long-term commitments like debt or new hires unless they're confident that they have costs under control. And at this juncture, they do seem confident. Looking ahead, middle market executives prophesy that their profits over the next year will increase 3.1%, while their costs go up just 2.1%. Even though payrolls grow, even though healthcare costs continue to rise. Three elements of costs, energy, raw materials, and interest rates, seem pretty much under control to them. As executives look ahead, the middle market emphatically retains its position as the place to be for growth and competitiveness, a powerful force driving expansion and job creation, and a cohort of companies that merits the close support and attention of all of us. Our website, middlemarketcenter.org, posts the entire middle market indicator, the data I've summarized here, the full report, and also the raw data for this and all previous MMIs. There's no cost to access the website or its data. There you will also find, in addition to the MMI, lots of other research from the center about such topics as building top teams, digitization, expanding trade in the Americas, and much more. The URL again is middlemarketcenter.org. And for the National Center for the Middle Market, I'm Tom Stewart.